Good morning, happy Friday. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. President Putin dangles deals and a new arms treaty. As the Russian leader launches a charm offensive with Donald Trump, we will preview today's crucial summit in Alaska. Coming in hot, Treasuries edge higher after falling sharply following data showing US factory gate prices accelerating by the most in 3 years. And Intel inside. Shares surge after a Bloomberg scoop that the Trump administration is discussing buying a stake in the beleaguered chipmaker. And stay tuned for Bloomberg Tech Europe. That's at 6:30, where we take a deep dive into how artificial intelligence is transforming the way we work. Let's check in on the markets then. So that rally in the US came to a close yesterday, flat by the end of the close, losing steam on the back of higher producer prices and raising question marks as to what extent we can be fully confident that Fed will go with its first cut of the year in September. So markets and trades are just readjusting. Now there's about a 90% chance being priced in by the markets that you will get that cut in September. Some of that being phased out then on the back of stronger producer prices out of the US. Nonetheless, futures here set for a fourth straight day of gains if these futures come to pass when the open starts. Of course, at 8 a.m. UK time, European futures on the front foot, pointing higher by 0.4%. And that is despite weak data out of China as well and concerns again about the health of that economy. FTSE 100 futures looking to add around 45 points. S&P futures then after a flat close yesterday on the back of that stronger inflation story, pointing higher by 0.2%. And then Nasdaq 100 looking to add just 6 points. Let's flip the board and have a look cross asset then. The focus, of course, was on the Treasury market reaction to those stronger producer prices, and you did see a sell-off with yields up across the curve. Today, that is moderating. You're seeing a bit of money moving back into US Treasuries. 427 yields down 1 basis point on the benchmark US 10-year. Euro-dollar at 116, stronger on the single currency, gaining against greenback by 0.1%. Oil in focus as well, and this could be the key asset in terms of the movements on the back of this geopolitical event that, of course, is the meeting between the two presidents of Russia and the United States in Alaska later today. So watch that in terms of potential reaction. Currently down and a little softer by 0.3%. And gold, the yellow metal, gaining 0.3 so far at 3,346. Let's check over in the Asian markets, though, because Japan has been a factor again, and this time on some stronger data. Min Low standing by in Hong Kong. Min.
Hey, Tom, it's a very, very busy Friday to end the week here because we have Japan reporting GDP, Macau and Hong Kong as well set to report GDP, and we have activity data out of China as well. But here you can see we are largely in the green today, and that's led by the Nikkei 225 up by 1.5%. Thanks to that GDP data coming in at 1%, beating analyst estimates, consumption picking up, business investment was better as well. So that resilience amid those tariffs really giving people hope that maybe the BOJ could finally hike rates perhaps in October. Traders are pricing in that 35% chance of a rate hike at that time. So we're seeing Japanese bank stocks in particular jumping on the back of this. The Nikkei up by 1.5%. We're seeing the yen strengthening as well. But flip the board, take a look at how we're doing in China. It's a very different picture because we have, of course, the activity data. We were missing every single metric. Retail sales, industrial production, unemployment ticked up as well because it's graduation season. 12 million new graduates entering the job market. Now we're seeing the Hang Seng extending declines here. Onshore still holding up pretty well. But flip the board, we're taking a look at the property sector because we did get the home sales data along with the activity data out today. And that showed continued weakness as well, continuing to show declines down 0.3%. It's been down for about 2 years now, and yet we're still seeing these property developers up by 1, 2, 3%. And that's thanks to what we are reporting, according to sources, that the government is looking at letting state-owned enterprises owned by the central government to come in to mop up those excess housing in the market. And that perhaps is feeding into some optimism that the government intervention might help turn the corner in the housing market.
Yeah, they have to reach for solutions, don't they, with that 4-year stretch now in terms of China's real estate slump. Min Min Lo in Hong Kong on a busy day out of Asia. Min Min, thank you. Meanwhile, Treasuries, as we mentioned, edging higher after a sharp fall following the hot wholesale inflation print yesterday, with traders trimming their Fed cut bets. So we've been whipsawed a bit this week in terms of those bets. For more, let's bring in Bloomberg's Valerie Teitel. Was it premature for markets to price in 100% in terms of September for this cut earlier this week, given what we saw from producer prices?
Well, that was the market reaction yesterday. That hot PPI print, the hottest in 3 years, did see the market pare back bets, but only slightly, Tom. We're still pricing around a 90% chance, above a 90% chance, actually, of that September rate cut from the Fed on September 17th. So that front end really was pummeled yesterday, but still, we are still 5 basis points lower on that 2-year yield since that CPI print that the market did take as cool. So net this week, we have priced in more for that September Fed rate cut. Now, the equity market took it in stride. We still did eke out a gain for yet another record for the S&P 500. And this has a little nuance, Tom. The components of PPI that feed into PCE, which is what the Fed targets for inflation targeting, those actually did not come in as hot as expected. So the estimates for PCE are still coming bang in line. A 0.2%, 0.4% rise is what we're expected to see in 2 weeks' time. We do see that indicator. So maybe that was an explanation on why the equity market took it in stride. But it was also this news about Intel. We have the Trump administration looking at a possible stake in the chipmaker. Intel shares did help the equity trade out into the close. Those shares rising over 7% and rising another 4% in after hours trade. But we still do have some risk events on horizon before we close the books for this week. The big one being at 1:30 U.S. retail sales. We also get import prices. And then at 3 p.m., we have the University of Michigan consumer sentiment for a big read on the U.S. consumer today.
OK, the retail sales data is going to be important, isn't it? Yes, the S&P closing up just 2 points. But to your point, a third consecutive record high, despite the very slim gains that came through yesterday on the S&P 500. Intel was part of that story. To geopolitics right now, Russian President Vladimir Putin seeking to strengthen his rapport with Donald Trump ahead of their summit in Alaska later today. The US president, meanwhile, is downplaying today's talks, saying that a follow-up involving Ukraine's leader will be more important.
We have a meeting with President Putin tomorrow. I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
Opening trade anchor Kriti Gupta is here with the details to set us up for this crucial summit then, and all eyes really on this meeting between the two presidents later today. It's going to be fascinating to watch how this all plays out. And the Russian commentary, at least the positioning leading into this, is, oh, by the way, it's not just the war, it's not just our special operation Ukraine. We can talk economics, we can talk deals, we can talk maybe arms treaties. So trying to play to some areas where, of course, they know Trump has interests.
Absolutely. I think the arms treaty is perhaps the most crucial one as well. The economic piece, where you're starting to talk about companies who've very publicly withdrawn from Russia after the invasion of Ukraine. That is a trickier sell when it comes to Western companies, not just American, but European ones, to regain that kind of business or to re-inject liquidity. Very kind of notable exits from that, from the likes of McDonald's, for example, from the likes of, I think, Nestle and Unilever as well, had some very public exits as well. Not to mention some of the oil companies. The arms treaty is the interesting one because Vladimir Putin has been trying to bring this back up with Donald Trump for some time. This happened during his first term as well, and under his first administration, with very little success. And the reason this is so crucial is because a lot of those arms control treaties that date back to the Cold War, so the 1980s, where you were dealing with the fallout of what was going on in Korea, South Korea, North Korea, tensions between India and Pakistan at the time. A lot of those arms control treaties that included pushing back and deterring nuclear weapon use have actually faded on both sides. You started to see some of the agreements expire. You haven't seen new ones come in. And you've most recently seen Russia pull out of the INF treaty, which talks about intercontinental ballistic missiles internally. So this is a really crucial moment, not just for talking about the Ukrainian piece, but also talking about the actual relationship between two of the world's most kind of heavily armed countries.
What does it mean in terms of this second meeting? Because President Trump himself has seemingly trying to tee this up as this is just the starting course. We get to the main course later, which is the second meeting, and Zelensky is likely to be involved, maybe European leaders as well. What in terms of the groundwork is likely to come out on the back of today's meeting that could lead up to that, what at least the president is suggesting could be the more crucial second summit?
Well, the idea here is simply whether or not you can get Vladimir Zelensky and Vladimir Putin in a room together. And we know this has been something that's been floated by the Trump administration several times, with talks in Ankara, for example, a couple of months ago, talks even in Europe, and arguably talks in the States as well. There was even a question of whether the two leaders would meet on the war front itself. And time again, you've seen a resistance to do that because of this question of secession of territory. Now, because of the security guarantees, where Vladimir Putin has said that is a non-starter for Ukraine, and also this idea that Ukraine needs to basically promise that they will never be a part of NATO, which again is a non-starter for Vladimir Zelensky. So very quickly you can see how you don't make a ton of progress. That being said, what's crucial about this is getting that second meeting, as you said, but getting Vladimir Zelensky in the room. I thought what was more notable about Donald Trump's comments more lately was European leaders may or may not be a part of that conversation.
We'll see if they can make that play and get a seat at that table, of course, at the second meeting, if indeed that second meeting comes to pass. Kriti Gupta with an excellent setup in terms of what is the crucial geopolitical meeting, of course, of the day, of the week, maybe the month, possibly of the year as well. We look ahead to that in Alaska, of course, the two presidents meeting, and we'll have full coverage of that in terms of the potential outcome as well. There's some great reporting on the Bloomberg terminal and on Bloomberg.com as well around the Secret Service trying to get hotel rooms and rental cars in Alaska to put their boots on the ground and make sure they have presence, of course, in the lead up to this summer. That's a fascinating read as well on Bloomberg.com. Now, to China's economy and more concerns there. Slowing across the board in July, with factory activity and retail sales really important in terms of the health of the consumer. Disappointing. The latest snapshot suggesting that Donald Trump's trade war is starting to weigh on the world's second largest economy. For more, let's bring in Bloomberg's Katia Dimitrieva, who is across all of this detail for us. Joining us out of Hong Kong, what happened in the economy in the second quarter then, Katia? Just frame for us how challenged this economy now is and what it means for China's leaders.
Well, it really was across the board, and we get this kind of data from China in these big chunks, and usually it's a mix, right? And this time it was really red across all of these indicators, so retail sales to factory activity and mining, as you mentioned, and of course the unemployment rate. And just a few size and scopes to give you an idea of what kind of data was presented today. So for the factory activity and mining, that was the slowest pace, so it increased, but at the slowest pace since November. For retail sales, we saw the weakest pace so far this year. And of course, that unemployment rate picking up as well, which is never a good sign for things like consumption and for sentiment, which has been really down. And really, that's the kind of the factor that we need to bring up in order to get real estate spending back online and overall consumption back online. Now, it shows two things coming through, I think, pretty starkly. One is something we were expecting, which is some give back from the pulling forward of the trade war. In other words, there were a lot of companies that were placing orders. Factories were revving during just before tariffs came into force. We were expecting in the second half for that to come down a bit. And so lo and behold, we're seeing that already happening. And secondly, I think it shows, really interestingly, China's government has been pushing to target these price wars. In other words, this race to the bottom that a lot of companies have when they're pricing things and prices go lower. It's really pushing down inflation. The country's been in deflation for a few years now. And so because of that, there's just less funding going and less financing and government support for a lot of these companies and industries like EVs. And as a result of that, we're probably seeing, factories getting hit here.
OK, Katia Dimitrieva, thank you very much indeed. And of course, we have to factor in and think about how all this plays into the trade talks as well between the US and China. Is this a China that is more constrained now in terms of the leverage that it has vis-a-vis the US, given the challenges of that economy? Illustrated for us, of course, by Katia with the analysis there. Joining us out of Hong Kong, Katia, thank you. Now, Israel, meanwhile, says it is planning to expand settlements into 3,000 acres of the West Bank, effectively splitting the enclave. The move defies Western calls to recognise Palestinian statehood and targets an area long excluded from settlement plans. Settlement expansion is widely seen as a violation of international law. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. terminal subscribers can go to DAYB Go. The setup, of course, in the lead up to that summit between the two presidents in Alaska later today, with all the reporting and analysis around that, is worthy of your time. Coming up, the Trump administration is said to be in talks with Intel over a possible government stake in the chipmaker. Details of our scoop next. Move the markets. Stay with us. Plus, Daybreak Europe's third episode looks into AI disruption in the labour force and the tech companies at the forefront of the oncoming revolution. That is at 6:30 a.m. UK time. We have some really smart voices breaking down what's happening in the labour market now and what's likely to happen in the future. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday, everyone. Bloomberg has learned that the Trump administration is in talks with Intel on the US government potentially taking a stake in that company. For more on our scoop, let's bring in Bloomberg's Robert Lee from Bloomberg Intelligence. What are the details then, Rob, in what could potentially be a US government stake in this chipmaker?
OK, well, as you said, our colleagues in Bloomberg News broke this scoop earlier today. And there's an unconfirmed story that possibly on the back of recent discussions President Trump had with the CEO of Intel, that there could be potential for the US government to take a stake in the business, which would obviously send a very strong signal both to financial markets and also, more importantly, their operational customers, that there is strong level of government support, that this business is potentially too big to fail, and that the US government is going to back them to the hilt on that front. So if this is ultimately confirmed, I think it could evolve into a potentially quite positive move for the company.
How unusual, Rob, in your experience, how unusual is this? If this does come to pass, if we do get a government stake in Intel, is there a precedent for this?
Well, for those of us who've been around the markets long enough, and you think financial crisis back in 2008 was that 17 years ago now? You know, the precedent was set during that period and maybe in prior financial crises before that. So if you remember, the government in the US took stakes in companies like General Motors and also, I think, AIG Group. More recently, the US Department of Defense took a $400 million stake in a rare earth materials company. So there's certainly a precedent there. You know, even for the world's, most capitalist country, I guess. So I think more importantly, though, there was some uncertainty with the change of administration following the earlier CHIPS Act. The CHIPS Act remains up in the air at the moment. We don't know whether the government is likely to provide funding to Intel and its peers on the US semiconductor front. So a potential stake, if that involves some monetary investment from the government into Intel, I think is something, again, the markets could take potentially quite well.
Well, certainly the market reacted positively yesterday, didn't they? Partly, presumably, because it seems like the CEO, Lip Butan, is safer in his role, at least, than he was maybe a couple of weeks ago.
Perhaps, although, as we know, I think the only certainty in the world we currently exist in is uncertainty. So whilst President Trump said some more critical things on Intel CEO a week or so ago, it seems they're on better terms this week. Who knows where things will go next week? But at the end of the day, Intel is one of the last remaining semiconductor companies of global status in the US. So I think from a strategic point of view, from a national security point of view, the US is going to want to do everything in its power to both support that business, to help get it firmly back on the growth track, to stabilize its balance sheet and financial outlook, and help ultimately secure it as a stalwart of the US semiconductor industry, which is a role the business occupied, for the best part of 50, 60 years or so.
OK, strategic and national security concerns likely being weighed then by the Trump administration as part of this potential stake that they could be making in Intel. Rob Lee from Bloomberg Intelligence with the context for us. We continue, of course, to watch and monitor that story as well. Rob, thank you. Coming up, staying on technology, Microsoft, Netflix and United Health, some of the names added by hedge funds in the second quarter. We have analysis of those filings with a particular lens on the moves around tech. And continuing coverage of the upcoming summit between Donald Trump and Vladimir Putin, we're going to be speaking to Richard Dearlove, former head of MI6. That's at 7:30 a.m. UK time on the opening trade. Stay with us for that conversation with the former spy chief. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Bloomberg analysis of second quarter 13F filing reports show that hedge funds added billions of dollars of Microsoft and Netflix shares. Chinese tech giant Alibaba, meanwhile, was the biggest loser in the fund portfolios, despite the progress they've been making on some of their large language models. Discuss the filings. I'm joined by Bloomberg's Ed Ludlow in London this week, co-host of Bloomberg Tech. So drawing on your expertise in the tech space with that particular lens on the US, Ed, what stood out to you when it comes to the tech space from these 13F filings?
Yeah, I mean, adding $12 billion of positions in Microsoft in the months of April through June is kind of interesting, insofar as like Microsoft was already, you know, an incredibly popular stock, and the run up to $4 trillion of value was happening around that time. The problem with 13Fs is that there's this 45-day delay, latency, between the time you take action you have to file. And April was kind of nuts in the world of technology. You know, we started that month anticipating the impact of tariffs from the president, and that mostly impacted hardware names. April 21 was the bottom of the market post DeepSeek, where all the names that we're going to discuss kind of rebounded heavily. But, you know, Microsoft, we understand its position in the AI market. Netflix, interesting. You know, it continued to show that its financial metrics are really good at a time it stopped giving us subscriber data. And that made it popular. And
the earnings story has been pretty positive for Netflix, hasn't it? But the valuation has been maybe a concern for some. What do we make of the changes? So Microsoft, lots of flows into Microsoft, but Meta being
on a dollar basis.
On a dollar basis, but Meta being cut in some of these holdings. So it's not necessarily a concern around CapEx spend. Or is it more nuanced than that?
Yeah.
How do we think about those two key players who are both spending very heavily on AI?
So Meta was cut by 147 different hedge funds, which to me seems like many.
Yeah.
There's nothing like deeply sinister in that period of time with Meta. You know, everyone was very fixated on capital expenditures, as you said. But Zuckerberg in that period of time was also talking a great game of what would happen next with their superintelligence team, and that's kind of coincided with all that Bloomberg reported on aggressive acqui-hires. Again, like Microsoft, it was already quite in a popular stock, you know, and you could track it against its year-to-date performance. But I just thought that data point was interesting. The rationale behind it, again, the 45-day distortion makes it hard to know.
And to your point, it performed very well, even up until April. One stock that hadn't performed so well, of course, was Apple.
Yeah.
And we had Warren Buffett, Berkshire Hathaway at least, trimming again.
Yeah.
Their holdings in Apple. What do you take? Is that a negative indicator or just a portfolio rebalancing?
If it's Warren Buffett, a portfolio rebalancing is more likely. You know, the funny thing about Apple is super interesting. The stock traded on tariff January through at some point in the second quarter. Really hard to pinpoint. Then near and around WWDC, the market sentiment around Apple really pivoted to a lack of AI story, right? We've seen that play out this week. Mark Gurman's brilliant reporting on how a tabletop robot is kind of the future of that, and there's a great degree of skepticism. But on a dollar basis, it's tiny trim on Apple, you know, relative to the scale of the holdings that are out there. Same with Alibaba, right? So the headline is Alibaba, the most, on a dollar basis, drop in value. It's only $1.5 billion, you know, which doesn't seem in aggregate. We're tracking $800 billion worth of hedge fund holdings in tech. Yeah. So it's like, on a relative basis, small. Yeah.
OK, that's why we need the context, which you give us, Ed. Thank you very much indeed. Ed Ludlow, of course, anchor of Bloomberg Technology here in London for us this week. Coming up, the next edition, talking of tech, Bloomberg Tech Europe. We're going to be exploring how AI is changing the way we work, the jobs we have and how we do them. That is next. This is Bloomberg.